Move $30,000 from your traditional IRA into a Roth at 63, and Medicare can bill you for it 2 years later, on the very first premium you ever pay, at 65. For a married couple, that is just under $2,000 extra across the year. For landing $1 over a line, nobody showed you. Not the market. Not the conversion tax you already paid. A tax return you filed 2 years earlier. And when a voluntary conversion is what pushed you over, there is usually nothing to appeal. Social Security will reduce that surcharge for a specific life-changing event. Retiring is on the list. Choosing to convert is not. So that one sits on your bill for the year. And that is the mild version. Sign up for Medicare Part B a year late, and the penalty is not 1 year of it. It is 10% more, permanently, for as long as you carry Part B. So the 5 years before your last paycheck are not normal planning years. They are deadline years. And the doors that matter most in there open once and shut for good. A Roth conversion cannot be undone. The Internal Revenue Service removed that option back in 2018. A missed Part B window prices your premium for life. A 2-year Medicare lookback locks a return you have already filed, and a surviving spouse cannot go back and reopen the joint tax brackets. One-way doors, all of them swinging shut inside the same 60 months. In the next 15 minutes, I will walk you through 5 countdown checkpoints, 1 per year, counted backward from the day you stop working, and 1 number to write down before you close this video. I am your guide to real-world retirement decisions, the ones that get made once and cannot be redone. And we are not going to panic about any of this. We are going to count it, 1 year at a time. And you may not get the full 5 years to use them. In the 2026 Retirement Confidence Survey from the Employee Benefit Research Institute, nearly half of retirees said they left work earlier than they had planned. Workers expect to stop at a median age of 65. Retirees actually stopped at a median of 62. The countdown starts whether you start it or not. Quick favor before we start it. If this is the kind of arithmetic nobody has run for you, tap like and subscribe now so the next one lands in front of you. And take the most time-sensitive piece first, because it is live right now. Under current law, the rule that removed the income cliff on marketplace health insurance subsidies expired after 2025. So for tax years after 2025, unless Congress puts it back, if your income for premium tax credit purposes, the income number the marketplace uses, close to your adjusted gross income, lands $1 above 400% of the federal poverty line, you do not lose a slice of the credit. You lose all of it, and you repay every advance dollar the government already sent your insurer. For 2026 coverage in the lower 48 states and Washington, D.C., measured against the 2025 federal poverty guideline for a 2-person household, that 400% line is $84,600. Alaska and Hawaii run on their own guidelines, and there is no longer any cap on how much can be clawed back. That is year 4. But the checkpoint almost every couple skips is year 2, and it is the one that decides what the tax code does to whichever one of you is left alone. Stay for that one. Year 5. 5 years before your last paycheck, not 5 years into retirement. We are counting down. Count your empty years. Between your last paycheck and your first required withdrawal, there is a stretch of tax years where you control almost every dollar on your return. While you are working, your employer sets your income. Once required withdrawals begin, the Internal Revenue Service sets a floor under it. In between, you decide. 2 dates set the length of that stretch. The first is the year you stop. The second is your required withdrawal age, and it is not one number for everyone. Born between 1951 and 1959, your required minimum distributions start at 73. Born in 1960 or after, they start at 75. That single line in the secure 2.0 rules is worth years of runway, and most people have never checked which side of it they are on. Run it. Say you are 62 right now, born in 1964, Planning to stop at 67. That is 2031. Born in 1964, your first required withdrawal lands in 2039. Count the full tax years in between, 2032 through 2038. 7 of them. 7 chances to move money out of the traditional account at a rate you choose instead of a rate the table chooses for you, because the table is not gentle. In IRS Publication 590B, the Uniform Lifetime Table sets your first-year divisor at 24 6/10 at age 75. That is a little over 4% of the balance, and the divisor shrinks every year after, so the required percentage only climbs. On a $1.2 million traditional balance, that first forced withdrawal is just under $49,000 of ordinary income you did not ask for, stacked on top of Social Security, on top of any pension. Depending on your age, these final working years may also be your last shot at the largest catch-up contributions. The catch-up for most savers age 50 and older is $8,000 in 2026. But between 60 and 63, Secure 2.0 raises it to $11,250, $35,750 into a 401k in 1 year. At 64, it drops back down. It is age-based, not retirement-based, so if you're already 64, the window has closed even though you're still working. Nobody mails you a warning either way. Write down 2 numbers this year. The year you stop. The year the withdrawals start. The distance between them is your best tax planning runway. The years when you, and not a table in Publication 590B, decide what shows up on your return. Year 4. Build the bridge to 65. If you stop working before 65, you are buying your own health insurance until Medicare starts, not until your full retirement age for Social Security. Medicare keys off your 65th birthday, full stop. And that one confusion costs people real money every year. And the bridge just got more expensive to cross badly. Those subsidies are measured on your household income for the coverage year against that $84,600 line. It is a cliff, not a ramp. Under it, you may qualify for a credit. $1 over, you qualify for nothing, and you repay the advance payments already made on your behalf. Now watch the collision. The conversions you planned in year 5 raise your income. The health insurance subsidy is measured on that same income. They are fighting over one number. Say your other income is $60,000 and you convert $30,000 from the traditional IRA. $90,000. Over the line. The conversion did not shave the subsidy. It erased the year's credit, and the repayment shows up on the following April's return. So year 4 is a choosing year, not an optimizing year. Between your last paycheck and 65, you generally pick one. Hold income down and take the subsidy, or push conversions and pay for the coverage yourself. Running both at full volume is how careful people end up with a 5-figure surprise. There is a second clock in this same window, and it is the one that gets missed. Medicare premiums are set on a 2-year look-back. Your premium at 65 is calculated from the tax return for the year you turned 63. So a large conversion at 63 does not show up in your health costs at 63. It shows up in your very first Medicare bill. Here is the size of it. In 2026, the standard Part B premium is $202.90 a month. A married couple whose income crosses $218,000 pays $284.10 each instead. That is $81.20 more per month per person, just under $2,000 across a year for the couple for crossing a line by $1. You do not have to master any of that. The whole task is one habit. Before you convert $1, look up which tax year Medicare will be reading and check what that conversion does to it. Map the look back before you convert. Not after. Year 3. Fill the cash bucket while the market is still up. Sequence of returns risk is the plainest unfair rule in retirement. It is not about what the market averages. It is about the order the years arrive in. Two retirees can live through identical average returns across 30 years and land in completely different places, purely because one met the bad years first. The reason is mechanical. Sell shares to fund living expenses in a down year, and those shares are gone at the low price. They are not there for the recovery. Every withdrawal in a falling market permanently removes capital from the rebound. And the danger window does not open on your retirement date. It opens 2 to 3 years before it. A serious decline right before you stop working does nearly the same damage as one right after, because you no longer have the working years to replace what it took, which is exactly why the buffer gets built in year 3 and not in year 0. The buffer is boring on purpose. 2 to 3 years of your actual spending gap, held in cash or short-term instruments outside the invested portfolio. Size it with subtraction, not with a percentage. Take what your household actually spends in a year. Subtract what arrives no matter what the market does. Social Security, any pension, any annuity income. What is left is the gap the portfolio has to cover. Spend $70,000, receive $40,000 guaranteed, and the gap is $30,000 a year. The buffer is $60,000 to $90,000. That money is not there to earn anything. It is there so that when the market drops 30% in your first retirement year, you do not have to sell into it. The permanent part of the damage comes from selling shares while they are down. A buffer does not make a bear market painless. You may still have to trim spending, and if the downturn outlasts the cash, you will be selling anyway. What it does is buy you the years, so the selling happens later and higher instead of at the bottom. And you do not need to memorize any of this. You need one number. What your household spends, minus what arrives no matter what. Write that down, and the rest of this step is arithmetic. And the timing is the whole point. In year 0, if the market has already fallen, building the buffer means selling at exactly the price you were trying to avoid. You cannot install a shock absorber during the crash. Year 2. Plan for the one of you who will be alone. This is the part almost no retirement plan contains, and for most couples, it is the largest tax event they will ever face. When one spouse dies, the household's income barely moves. The shelter around that income, the deduction, the bracket space, the Medicare threshold, shrinks toward half. 3 things happen at once. The smaller Social Security check stops. Whichever benefit was bigger is the one the survivor keeps. The other simply ends. In a household where one check was $2,200 and the other was $1,300, that is $1,300 a month gone from a budget that still has to cover the same house, the same car, and the same property tax bill. The filing status changes. For the year of the death, a surviving spouse can generally still file a joint return. Starting the following tax year, they file as single. In 2026, the joint standard deduction is $32,200 plus $1,650 for each spouse who is 65 or older. A single filer, 65 or older, gets $16,100 plus $2,050. $35,500 of shelter becomes $18,150 before any temporary senior deduction and its income phase out, which can soften the drop for some households and not for others, and the brackets compress. The 12% bracket that ran to $100,800 on a joint return tops out at half that for a single filer. Medicare's income surcharge threshold behaves the same way. $218,000 married, $109,000 single. Put it together in one sentence. Same house, less income, smaller brackets. Surviving spouses describe it as their taxes going up in the worst year of their life, and they are describing it accurately. There is one lever that does the most about this, and it only works while both of you are alive. Money moved into a Roth while you are still filing jointly leaves the survivor's taxable income for good, once a Roth IRA withdrawal is qualified, and that generally means the account has been open 5 years and you are past 59 and a half. It does not land in taxable income at all, so the compressed brackets never reach it. Converted dollars and workplace Roth accounts run their own clocks, so ask your preparer which date applies to which account before you count on it. It does not undo the lost Social Security check, and it does not make the single filer brackets go away. It shrinks the pile of income those brackets get to squeeze, which means the conversion runway you counted back in year 5 has a real deadline, and the deadline is not your required withdrawal age. It is the first death. Year 2 is when you finish, not when you start. Year 1. Run the whole thing for 12 months before it is real. Everything up to here has been arithmetic. The last year is a rehearsal, and it is the only step on this list that tells you the truth about the other 4. Here is how it works. Calculate what your retirement household will actually receive each month. Social Security, pension, the planned portfolio withdrawal, net of tax. Move exactly that amount into your checking account on the first of each month. Every dollar of your paycheck above that number goes straight into savings, or the 401k, untouched. Then live on the retirement number for 12 months. 2 things come out of that year, and both of them are expensive to learn later. The first is your real spending number, not the one in the spreadsheet. The number your household actually runs at, including the dental bill, the roof, the year the car dies. Most people find the gap is not where they expected it. Far better to find that while a paycheck is still arriving. The second is a pile of cash. Every dollar above the retirement number you did not spend goes into the year 3 buffer, banked at the moment it matters most. Year 1 is also when the enrollment paperwork stops being theoretical. Your Medicare initial enrollment period is 7 months long. The 3 months before the month you turn 65, that month, and the 3 months after. Miss it without other qualifying coverage, and Part B costs 10% more for every full 12-month period you were eligible and did not sign up. Permanently, for as long as you carry Part B. If you are still working at 65 with real employer group coverage, you get a special enrollment period of 8 months, and that clock starts when the employment or the group coverage ends, whichever comes first. 8 months, not indefinitely. And 2 details decide whether you have that protection at all. Retiree coverage and COBRA do not count as active employer coverage for this purpose, and at many employers with fewer than 20 workers, Medicare may be expected to pay first, so you cannot assume the work plan protects you. Call the plan administrator and ask which one you have. It is a 5-minute phone call that decides whether a penalty follows you for life. One last piece of arithmetic for the final working year. It is usually your highest income year, and every dollar of it sits on the same tax return that will set your Medicare premium 2 years later. So, in one line, the 5 years before you stop working are the only years where you hold every lever at once. The income on your tax return, the account each dollar sits in, the insurance you carry, and the cash pile that decides whether a bad market is a problem or a disaster. After the last paycheck, those levers disappear one at a time. 2 households can start these 5 years with the same salary, the same savings, the same market ahead of them. One of them uses the empty years, maps the 2-year Medicare lookback, and builds the buffer while prices are high. The other does nothing in particular and finds out afterward. 10 years on, the first one is paying the taxes it planned for. The second one is meeting a required withdrawal, a premium surcharge, and a single filer bracket in the same January. Nobody got unlucky. One of them just used the 60 months. And remember the survey. Nearly half of retirees left earlier than planned. Your countdown may already be shorter than the one you're picturing. That is not a reason to panic. It is a reason to do the year 5 step this week instead of next year. If you do one thing after this video, do that one. Write down the year you plan to stop and the year your required withdrawals begin. Subtract. Whatever number you get is how many chances you have left, and it drops by 1 every January. This is not financial advice and not legal advice either. Run your own household's real numbers with a fiduciary and with a tax professional for the conversion math. For the Medicare enrollment questions, your state's free SHIP counseling office will walk you through it at no charge. If this gave you a number worth running, the like button genuinely helps this reach the households that need it, and subscribe so the next one finds you while you still have the years to use it. And in the comments, type the word countdown if you want me to walk through the empty years math with real household numbers. I read them. See you next time.